All right, America's 16th largest bank has collapsed. That's the big news right now. The damage and the fallout relatively contained, I should point out. This after Silicon Bank had slid more than the stock, at least, at 60% in just the last 24 hours or so. It was forced to sell a roughly $22 billion bond portfolio, and it recognized a nearly $2 billion loss, I believe $1.8 billion when all was said and done. The CEO, to whom we've reached out, Greg Becker, was on the wires indicating that the financial institution will still be well positioned. It is well capitalized, but that did not stop government regulators from saying, no, we're shutting you down. Depositors are going to be protected through the FDIC. Seems to be localized. Back with Gary Kaltbaum, Susan Lee. Gary, everyone is saying the right thing, and then looking at stock prices right now, they are relatively contained, nothing like we saw with the first hints of problems, certainly during the Lehman Brothers situation, and so much more. AIG back all those years ago. So they say, very different world now. Do you agree with that?
I think so. The leverage back then was gargantuan. I'm pretty sure we don't have that. Hopefully they learn lessons. And look, I'm very happy that the regulators came out and are yapping loudly about this, because there is that word, the intangible, confidence. The loss of confidence will send things lower, so good move on their part, but we'll have to deal with reality going forward. What else is out there? And again, I expect a lot of banks to make announcements in the next couple of weeks saying, hey, we're in good shape. No problems here, and that'll be a smart move. But I want to just touch one thing, because we're talking about those 0% interest rates and the easy money and the printing. That was not the real world. That was the decision of a select few people at a central bank to take rates down, screwing every saver and causing a lot of this trouble. It creates distortions for when the real markets come around. And that's what we're seeing now. The real market, interest rates higher where they should be, that's where you're seeing the trouble, where losses are attained. And I can tell you, just on a small scale, bond funds over the last year and a half, there are some down between 25 and 50% because of the leverage they had. And that's something that probably is going to need to be addressed going forward, especially if we start to see yields in the 4.5%, 5%. I'm talking about the real market now, not Fed funds.
Yeah, you want to retreat. You're right. You want to retreat from that. Susan, real quickly, we're learning about the TikTok on all of this. That, you know, the bank's customers, we're talking about Silicon Valley Bank's customers, you know, they're funded by startups and investors that fund the startups, and they were getting antsy. The Wall Street Journal is reporting that because a lot of these investors have taken a big hit since the Fed began raising interest rates, they just wanted to sort of get out of Dodge, take their money and run, to Gary's point, and it fed on itself. Obviously, the devil's in the details. Your thoughts?
Yeah, just quickly, I think the everything bubble has burst, especially with the second California bank in just a matter of weeks to go under. And so those zero rates, and you're seeing this in real time, the fact that you're seeing these stress points, I think that's being played out in the markets right now.
Well put. And guys, we should just expand. I want to thank you both very, very much.